AIM-listed Central Asia Metals has reported interim results for the 6 months up through to the end of June, a period that we're reminded by the chief executive, Nigel Robinson, was marked by weak commodity pricing, which led to a 12% drop in revenues year on year, leading to a 6% drop in earnings per share. But EBITDA margins, that's the measure of the company's operating profit as a percentage of its revenue, have been held at 63%. So with all this in mind, let's speak now to Nigel Robinson, who joins us here in the hot seat. Good to talk to you. It's a good story, actually. We've spoken to your chairman before about this, and we've been talking about the steady as she goes situation, but you are very much obviously dependent on the environment and the pricing of metals, the underlying metals themselves, which has been tough, hasn't it?
It has been tough, yes. And as you rightly say, we are a price taker. We're a small producer in the commodity markets. Copper, something like 13,500 tonnes is our top end of our range this year in a market that's 22 million tonnes. So we do generally have to take the price. But our business model is really based on maintaining a low-cost operation, both at Kunrad in Kazakhstan and also at Sasa in North Macedonia.
So at this 6-month period, you're confident about the full-year projections and returning what you are promising investors? Absolutely.
I mean, we're confident on the cost. What we can control, we can control. So we're confident on the cost base. We've announced this morning that our costs have come down period on period at Kunrad from 53 cents per pound to 51 cents per pound, and we're confident we can maintain that kind of level of low-cost operation. We've been operating there and producing copper there for over 8 years now, so we know the operation well, we know the cost base, we know the people, we know the salaries we pay, and the cost of the reagents and electricity, etc. We have had some benefit from a favourable tailwind, I think it's fair to say, in Kazakhstan, where 60% of our cost base is in the local currency called the tenge. That has depreciated against the dollar, which gives us a favourable impact on the cost base. Likewise at Sasa, we purchased that asset 2 years ago now, or almost 2 years ago, in November 2017. And one of the reasons we purchased it was because it was a low-cost operation, and we've maintained that low cost. And even though this morning we've announced a slight increase in the unit cost, up from 44 cents to 47 cents, a lot of that is for costs that are kind of outside of our control, because they are the treatment charges associated with refining the end product, the zinc in concentrate, which has gone up worldwide because of a shortage of smelter capacity.
For investors, it's quite good you've been able to maintain the dividend, of course, but also I noticed that you've reduced your debt, which is also good. It's come down from, I think, 110 down to $100 million, hasn't it? What's the thinking behind that? Do you intend to continue to pull that down? Is there a need to do that? I mean, because presumably if you're using cash to pay off debt, you're not paying a dividend. Or not paying in an increased dividend.
Our capital allocation strategy, if you like, is to do both. We have, at the time of acquiring the Sasa mine in North Macedonia 2 years ago, we took on debt. We'd never had debt in the business before that, and we'd always paid a dividend to shareholders. We made almost a pact with the shareholders at that time that we wouldn't allow the impact of taking debt on to, effectively have a negative influence over paying dividends back to shareholders that we've become well known for in the market. And this morning we've announced a 6.5 pence dividend. That's the third year on the roll, basically, for interims that we've paid 6.5 pence. We've now paid back 98 pence since we listed about 10 years ago on IPO in September 2010. That's $176 million. So we are renowned for having a good track record of paying back dividends to shareholders, and I think this morning reflects that. But the debt requirements, obviously there's an obligation on us with the banks to pay that debt down, and our cash flow forecasts on those low-cost assets indicate that we can do both. We pay about $38 million a year back of the debt and estimate that in the next 2.5 years or so we'll be down to zero debt within the business. Now, all that's predicated on not acquiring another opportunity to grow the business, which ultimately we will have to do. But at the moment, we feel that we've got the priorities right to pay dividends back to shareholders as well as pay the debt down as quickly as we can.
Is there no headroom to increase production there? Now you're talking about acquisition for growing rather than growing the business as it is?
That's a good question. Primarily we are. There's a little bit of headroom to grow maybe the output at Sasa, and we are looking at that through a life of mine review, which the newly appointed Chief Operating Officer, Scott Yellen, will report to the board in the fourth quarter this year. But really we're maybe there talking about an output of an increase, maybe 7.5%, 10%, that kind of magnitude, not a huge increase. And so as a mining company, we have low-cost, long-life assets out to 2034 at Coonrad and 2038 at Sasa. But ultimately, we have to replace those assets because we are slowly diminishing the life of those assets as we eat into them. But at the right time, there is no rush as far as the board's concerned to go out and acquire another asset. It's a little bit opportunistic in mining, as I'm sure you've found with other mining executives, whereby the jurisdiction is what it is or the technology is what it is, and you have to, you know, look long and hard to actually find those opportunities. But
let's bring up a share price, first of all, zinc, because I think this zinc is produced at the Sasa mine in North Macedonia, and I mean we're reminded here we've just recently seen lows not seen since September 2016. You overlay the Central Asia Metals share price on this, very similar sort of move. I mean, how difficult is it? You say you've got good margins, but clearly with a pullback in price, there's a squeeze going on somewhere, which either you're absorbing or you're able to offset that with lower costs. How are you dealing with this drop in the base metal? Zinc here and copper as well at the Coonrad, another one that's responsible for a squeeze, doubtless, at some part of the business. This is the lowest we've seen recently since June 2017.
Yes, I mean, obviously prices are down and there's not a lot we can do to influence that. We don't really have a hedging policy in place. We have a hedging policy that allows us to hedge, but we don't generally hedge. We believe that our shareholders invest in CAML for the exposure to the metals that we're involved in, effectively. Now, that's historically been the case, and so really our business model is predicated on maintaining low costs. If you take copper today, yes, it's a low price and there's quite a bit of pressure because of the macro demand picture. But if you take the copper price today at 5,850, I think it was this morning, our C1 cash costs are around about $1,100 per tonne. So our business model is predicated on having a strong leeway. So we operate in what's known as the lowest quartile of the cash cost curve. So lots of other mines will be in difficulties before we are when the prices come off from, as they have done over the past 6 months.
Do these declines in some of these prices provide you with an opportunity, do you think, in terms of acquisition?
Yeah, potentially they do. I mean, it's fair to say. But I think if you look to most analysts, when you ask them what they view the copper market to be in the near to medium term, it might be under pressure at the moment because of the demand picture. Longer term, I think there's a consensus out there that the supply deficit will happen in the copper market, both from an increased demand from electrification of the world, but also because it's getting harder and harder and more difficult jurisdictions, lower grades on the mines, higher capital required. People don't invest maybe on copper prices as they are today, and therefore there's a lag. And that's the same in zinc as well, actually. You always find this lag in the markets whereby you'll then find that the market will turn from what's a surplus to a deficit and prices will respond accordingly.
Do you have any idea amongst the analyst community you're talking to about pricing for next year for the base metals?
We talk to people on that, yes, and there are differing views. I think it's fair to say over the last 12 months most people's prices have come down. What they were predicting 12 months ago is lower now, what it actually is, than what they were predicting. But I think generally, if we're looking out beyond about 2022, 2023 in the copper market, there is expected to begin to be a bit of a supply deficit. Likewise, zinc is a different market. In zinc, we have to send our product that we make at the Sasa mine and the lead as well in a concentrate form to a smelter. And there you've got another player in the middle of that market, and there is tightness in the smelting market, and therefore treatment charges have increased, but there is an increase in supply of the actual mined material. And so there's probably a surplus of zinc concentrate in the world, but there's a shortage of treatment capacity, and therefore you're seeing treatment charges going up. You're actually seeing low inventories in the warehouses of both those metals, but actually the prices have come down, I think because of the nature of the volatility in the world and the demand picture, really, which is depressing all these prices. Just
for one final question, I want to bring up the share price again of Central Asia Metals and remind ourselves of 191.8 pence here on this AIM listed stock. In 6 months, when we talk to you again, what's going to be the message that you're going to be bringing to the table, and where do you see the business going in 2020?
Yeah, I think the message will be similar, if I'm honest with you. I mean, that might sound very boring, but we'll have paid off some more debt. We'll be looking to maintain a healthy dividend and a dividend yield. We generally pay a slightly lower dividend at the interim stage as we assess the market for the full year, but we'll be looking to maintain dividends with our shareholders. And if the market turns, and nobody knows when that might happen, we'll be looking, as we always are really, for other opportunities. But it's difficult to say when we'll land on one of those opportunities, when the time is right and it's the right combination of jurisdictions jurisdiction, technology, to actually start growing the business from what is a very solid and stable platform and low-cost platform at the moment.
Yeah. Okay, well, we look forward to speaking to you then, okay. Nigel. In the meantime, thanks indeed for joining us. Nigel Robinson is Chief Executive of Central Asia Metals.